Good morning, everyone. My name is Divas Gupta, and today we will be having the revisionary sessions on securitization and derivatives. So, in the previous segment, you would have gone through the detailed sessions on securitization as well as derivatives. So, the structure for today's discussion will be that we will be covering some of the concepts on revisionary basis, and then we will be also taking up some of the case studies which would have already been uploaded onto the portal. So let's start with the securitization revision first. So securitization, students, we started with a case wherein we said that let's assume that there is a loan taken by Mr. A from a bank, and that nature of loan was home loan. Now, against this loan, Mr. A would have promised to the bank to repay interest, to repay the principal as well as interest on the amount that he has borrowed. And the tenure for this was 25 years. Now, with this setup, we said that banks' earnings capacity becomes limited because banks have committed itself to 25 years for a cash flow with Mr. A, and the turnaround of this money cannot happen because these are committed for the long term purposes. So this was the balance sheet, the way we presented for bank, wherein we said that whatever deposits that we do to the bank are appearing on the liability side. The recurring deposits, savings bank account, whatever savings we do with the bank is again the liability. However, the home loan that they have given appears on the asset side of the bank. Correct? Now, this home loan was what we were talking about, that if let's say if we accumulate all those home loans, it turns out to be 100 crore. But against those 100 crores, the earning capability would only be limited to 9 crore if let's say the interest is 9%. Correct? So, in a way, to increase the earning capability of the bank, what it will do, this is an illiquid asset, first of all, the home loan that we have given. Why we are saying illiquid asset? Because it is committed for 25 years. The liquidity, or let's say the cash realization probability is low as of now, right? So what we have done, we have taken those illiquid assets and then we will sell those illiquid assets. That means you're selling the loan itself. While selling the loan itself, you will realize the cash, right? You will realize the funds. And again, those funds can be lended out in the form of a loan. So if you see, the same amount of 100 crore can get rotated multiple times, and hence the need of securitization. Because the bank's primary objective is definitely to loan a situation, but not only to keep that, but to grow the loan book as well, right? So this is a method of growing the loan book for the bank. Now, herein we said that what does loan represent, students? Loan represents the right to receive the interest and principal repayments. Correct? So, if Mr. A has taken a loan from bank, Mr. A have committed to the bank that he will repay the interest and repay the principal and pay the interest on the loan. Correct? Now, housing loan, students, is also called as mortgage loan. Why mortgage loan? Because the house property for which the loan is taken is always mortgaged while creating this loan obligation. So there is a charge created on the house. So these are called as mortgage loans. Now, if you see the entire chart, the way it works is there is a bank who has given such loans to, let's say, Mr. A and another thousand of such borrowers. So there is a pool of such loans that is available. That pool of loans is clubbed together because they have similar nature and characteristics when it comes to risks. Similarly, if you see, all these thousand borrowers would be for home loan, let's say, because these are the similar nature and characteristics. All of them will have a tenure from, let's say, 15 years to 25 years, which is a higher tenure because home loan is generally given for such tenure. And hence, you will end up having the portfolio of similar loans like this. Now, what you will do, you will just accumulate them, and then bank, what it will do, bank will create an SPV, or if there is a already created SPV, bank will sell these assets, sell these pool of funds, pool of loans to SPV. SPV will pay the amount to the bank today. Let's say we assumed 1 crore each borrower, 1,000 borrowers were there, so 1,000 crores. So the SPV will give 1,000 crore today to the bank, and bank will transfer the right to receive interest and principal to SPV. That means the bank will transfer loan to SPV. Clear, students, till now? So if you see, the bank has financed the loan that they have given, correct? And again, they have realized the amount which further can be given as a loan. Now, what will SPV do? From where the SPV will get funds to pay 1,000 crore today? How this assessment will happen? That what is the right value of this loan? So all these questions we are going to answer now. Now, what will SPV will do? SPV will reach out to some of the high net worth institutions, let's say, who are willing to invest, who are surplus on cash. They are always sitting surplus on cash. So, for example, pension funds, mutual funds, banks, institutional investors, and HNI. So, if you see, all these institutions are those institutions where the surplus amount is sitting, right? And they are willing to invest. So what they will do, they will invest into SPV. They will, let's say, all of them collectively will invest 1,000 crore into SPVs. So HNIs is basically high net worth individual. Okay. So all of them put together will infuse funding into SPV, and then SPV will pay according to that. Clear? Now, how the funding will be infused to SPV? By way of smaller denominated securities. This is the main part of the process. So if you see, these securities are what? These would be denominated as, let's say, 1,000 face value into 1 crore securities for 1,000 crore. Okay. Now they will be subscribing to these securities. These are just like shares of a company. Correct. So these are just like shares of the company. The only point is, now here the SPV is issuing the securities in its own name, and the investor segment is a specific segment who is willing to invest. Clear? Now, if you see, these securities are converted from the illiquid assets. Right? We started our journey from these illiquid assets of 1,000 crore, and they have been converted into a security. So this process of converting an illiquid asset into a security is called as a securitization. So this is the process of converting illiquid assets into marketable securities. Why we are saying marketable securities? Because these securities are subscribed for by these institutions, pension fund, mutual funds, banks, institutional investors, and HNIs. So all of them have invested through these securities. Clear, students? Perfect. So this process is called a securitization. Now, since these pool of assets were mortgage loans, correct? Since these pool of assets were mortgage loans, so even the mortgage part will also get transferred to the marketable, or even gets transferred to the SPV, right? Because if the loan obligation is getting transferred to SPV, tomorrow the rights attached to that loan obligation will also be transferred to the SPV. Okay. Now there are two different terms, students. One is mortgage backed securities, one is asset backed securities. So the mortgage backed securities are such securities against which there is an underlying of mortgage. Okay. Like in our example, the loan was given for the purpose of home loan and the mortgages were created. So these are called as MBS, mortgage backed securities. So in a way, if you convert your illiquid mortgage loans into marketable securities, okay, if you convert your illiquid mortgage loans into marketable securities, then these marketable securities are called as mortgage backed securities, MBS. Sorry, because they are backed up by mortgages. Okay. Similarly, asset backed securities will mean those securities where the backup is automobile loan or other receivables. Clear? So in this case, the underlying on which the loan portfolio is created is automobile loan, other receivables, maybe credit card receivable or other things, right? Other type of loans. So those securities are called as asset backed securities. Now, now this entire scenario of securitization, one, there is a borrower. Borrower is the same person who has borrowed the amounts from bank, right? Then second is originator. So originator is the person who has given the loan, who has originated the transaction. Okay. Then third was our SPV, right? Which comes into the picture by purchasing those loan portfolios from the originator. Correct. Now, if we say that 1,000 borrowers, 1 crore each, 1,000 crore loan was there, again continuing with the same example, there is a 20% probability of default. Now, if you see against these 1,000 borrowers, there will be some default that would be expected out. The answer is yes, because it cannot happen that all the borrowers will service their obligations properly. There will be some lapses in that. So we are assuming in this case, let's say 20% there is a probability of default, and the default will happen equivalent to the 50% of the amount. Okay, they will not default on the entire amount, but they will only default on the 50% of the amount. So that means on 1,000 crore, 20% there is a probability of default, and 50% there will be the default, and hence 10% overall on 1,000 crore comes out to 100 crore. So 100 crore, there is a default that is expected. Now the question comes, this 100 crore default that is estimated will be taken up by originator or will be taken up by SPV. There can only be two situations, right? Either originator will bear the loss or SPV will bear the loss. Now this will depend on the type of arrangement that they have done. So the first type of arrangement is on a recourse basis, students. A recourse basis means that the risk will always be with the originator. So recourse means that SPV will have a recourse back to the originator. Non-recourse means that SPV will not have a recourse to the originator. SPV will have to bear the loss. Right? Recourse means that you have one kind of a support from originator. Non-recourse means that you don't have any support. Whatever is the loss that you will have to bear. So clear, students? So Recourse basis allows SPV to get funds from originator in case borrower's default. Non-recourse, no entitlement to the funds from the originator in case the borrower defaults. So that means in non-recourse, the risk lies with the SPV itself. Now 100 crore if let's say is the actual default. Recourse, in case of recourse, the hit will be with the bank or originator. In case of a non-recourse, the hit will be with SPV. Okay. Now, there are borrowers, there are originators, and there is SPV, right? Till now we have discussed. Now, what happens, students? SPV have three different objectives, right? One, or let's say three different functions, I would say rather, not objectives. One, to keep on receiving and maintaining the loan book and keep on keeping the records, right? That what was the initial value of the loan for the different borrowers? Now, how much have been received? How much will be received in future? So those are the tasks of SPV. For this, SPV will appoint a receiving and paying agent. The primary purpose or the primary function of a receiving and paying agent is it will collect the funds from the borrower, and it will, after collecting, it will pay the proceeds to SPV. Okay, so the core function of receiving and paying agent is to make sure that, let's say, collections are properly accounted for, it is properly received and paid. Okay, so SPV kind of outsources this to receiving and paying agent. Now, if you see from investors' point of view, investors cannot go and check each and every document of loan that the borrowers by themselves, correct? While they are dealing with SPV to invest into SPV, but the underlying for which that they're investing into SPV is the loan itself. So they cannot go and check each and every loan of these 1,000 borrowers. So what do? They ask SPV to get themselves credit rated, and the basis for that credit rating will be the loan part where these loans are given. So those loans will be evaluated by the credit rating agencies. In this case, the credit worthiness of the borrowers will also be evaluated as a whole. As a group, what is the credit worthiness of this group? That will also be evaluated, and accordingly, credit rating agencies will come up to an opinion and they will issue a credit rating. Now, that rating, if it is good, or let's say if it is excellent, then the investor's confidence to invest into the SPV will increase, and the amounts of interest or return expected can also go down, because if the risk is low, the returns expectation will also be low. But if the risk is high, the return expectation will also be high. Yes, Prashant is asking what is the basis of rating for SPV. So as I said that SPV is purchasing the loan. So the basis of rating for SPV will be the loan itself, which bank has given to the borrowers. And for evaluating the credit worthiness of the loan, the credit rating agency will also see what is the credit worthiness of the borrowers whom they have taken a loan, what is their repaying capacity, how those assessments were done. No, it will be loan, Prashant. See, security is basically an outcome. Let me clarify here. Security is an outcome. The underlying to this security is the loan. Now, today also, if you see, if the credit rating agencies give a credit rating to a company, that is used while they issue a debenture, which is a security, right? Which is again an outcome. But what do? They evaluate their business, which is their underlying. That what is the cash generation capability of a business, correct? So the evaluation will happen for business. The overall outcome will be there for a security that will be issued as a debenture. Now, in this case, the security is issued as an outcome, but instead of business, they are generating their cash flows using the loan. So they will evaluate the credit rating basis the loan. Okay. So this will eventually help the investors determine whether their investments are happening in the right, let's say, risk appetite levels or not. There are some investors who are willing to invest into the highly risky ventures as well because the risk appetite is high. In that case, they will be expecting a higher return, students. Okay. Now, next comes on the securitization instruments. Yeah. Now, securitization instruments, students, there are different types of securitization instruments. The first one is pass-through certificates. What is the meaning of pass-through, students? Pass-through means that whatever has come in, it will go out in the same proportion. Okay, pass-through means that you are just a pass-through entity. You are not having anything of your own. You don't carry any risk and rewards of your own. Whatever rights and obligations you're receiving, you're passing the similar rights and obligations further. Then the second is pay through securities, PTS. So we'll cover that. What is the meaning of pay through securities? And the last one is stripped securities. Stripped means that you are segmenting your securities. There are different segments of a security. Okay. Now let's understand this better. So students, whenever we talk about securities, let's say we talk about debt. Okay. Which factors influence the pricing of debt? It is interest rate, right? This, although there are many other factors, let's say there is a factor of risk, there is a factor of recoverability, but the major factor is the interest rate. If the interest rate goes up, the debt value will go down. If the interest rate goes down, the debt value will go up. That's the inverse relationship that is there between a debt and a interest rate. Now, if we talk about equity in the form of earnings and dividend, they will have an underlying of a business. There is no fixed commitment that is there, right? Then in case of mutual funds will have NAV, right? It can be equity or debt, but it will be driven by NAV, the values, net assets values. Derivatives, we will cover, although in detail you all would have covered, derivatives derive their value from a underlying, which can be equity share, which can be commodity, which can be foreign exchange, right? Then mortgage backed securities and asset backed securities have mortgage loans and receivable as their underlying, right? And any other securitization related securities will have the pool of funds or the illiquid assets below them. Now let's come to the discussion on the different type of securities. Pass through certificate, students. So pass-through certificates are those wherein the amount that is being received is passed as on. There is no proportion that is required to be put. For example, the borrower is there, SPV is there, and investor is also there. Now, let's say the securitization has already happened. The securities have already been issued. Now, after that, the collections are happening. Now, in this case, let's say while receiving the collection, 100 rupees of principal is received, 50 rupees of interest is received, and 150 rupees prepayment is also received. So that means we are receiving in totality 300 rupees. Now this 300 SPV will transfer to investor as is. Okay, let's take the second case. In the second case, 100 rupees of principal and 50 of interest is only received. So this 150 again will be transferred to the investor. Third case, students. In this case, there is a default in payment. Borrower, instead of 100, only pays 80 rupees, and interest, instead of 50, it pays 0. So the total amount received is only 80. Now this 80 will get distributed proportionally to investors. So if you see, in all the three cases, if you are receiving higher amount, the higher will get distributed. If you are receiving the committed amount, which is case 2 is committed amount of 150. If you're receiving that, then also it will get distributed. Then in case 3, if you're receiving a lower amount, even in that case, the amount will get distributed to the investor, students. So for investors, pass-through certificates means proportionate shares in cash flows of SPV, students. Okay. The cash flows of investors would be linked to cash flows of mortgage loan held by SPV. Clear? So everything is very much proportionate and it is used for the similar pass-through amounts. Now let's come and see what is the distinction when it comes to pay-through security, students. Now, in pay-through securities, the actual amount received is not given that relevance, because here the cash flows of SPV to the investor is fixed separately. Now here, let's say there is an agreement between SPV and investor that 200 will be a guaranteed cash flow. This is already agreed now. So SPV in all the situations will have to pay 200 rupees to the investor. There is no higher amount or a lower amount in question. It will always have to be 200 rupees. Now, how will this be achieved? Let's see this. Now, borrower actually in the first case, it prepays 150 rupees. That's what we have assumed, 50 and 100 and 150. So in totality, there is 300. And then 200 is what is reduced. So finally, 100 is what is there, which is actually invested. So this is basically distributed to investor because we have committed that we will pay 200 rupees, right? For 300 is the collections received, right? Now balance 100, what will happen? Balance 100 will get invested in SPV itself. Okay. But investors have only got 200. Now tell me, students, had this case been for pass-through certificates, what amount we would have paid to the investors? What amount we would have paid to the investors? 300. Very good, Prashant. Now let's come to case 2. In case 2, 100 rupees principal is received and 50 rupees interest is received. In such a case, 150 is received, 200 is our commitment, 50 rupees there is a shortfall. This shortfall will be realized from the earlier investment that we did for 100 rupees here. Okay, can you see the real difference here? So the real difference is still 200, what is committed will be paid. This 200 is committed is what it will be paid, students. The 50 rupees of shortfall will be actually taken up from the previous investments. Now let's come to case number 3. Now case number 3, there is a 0 rupee that is received. Entire amount is default. There is nothing that is received. So we still have to pay 200 rupees to the investor, the SPV. How will it pay? 50 rupees through earlier investment. Because 100 rupees was the original investment. Out of that, 50 was paid in step 2, 50 is left here. And balance 150, they will borrow a fresh. Clear? This is for case 3. Now, let's come to the situation where we are explaining a pass-through entity. Let's say there are 3 entities, entity A, B, and C. And entity B, we say that it's only a pass-through entity because entity B is not having any business of its own. No business of its own. Only business is happening for entity C. So this entity B is called as a pass-through entity. Okay. Now, PTS, pay through securities. The cash flows of investors is not linked directly to the cash flows of the mortgage loan held by SPV. Clear? So the cash flows are not linked. Surplus can be invested, shortfall can be borrowed. This is for pay through securities. Pay through securities, separate identity from that of the mortgage loan. Pass through certificates, same identity as that of the mortgage loan. Because if some higher or lower amount is being received, that is also being factored into in case of a pass-through certificates. Okay. Now, pay through securities, there is a complete desynchronization that is happening. The cash flows to be paid to the investors and cash flows to be received from the assets are totally desynchronized. Whatever SPV is supposed to pay and SPV is supposed to receive is totally desynchronized. So there is no stability in cash flow spikes. So stable cash flow securities. So we are talking about now pass-through certificates and pay-through securities, students. So pass-through certificates, there is no stability because today if you receive higher, you will end up paying also higher. If you today receive lower, you will end up paying tomorrow also lower. For pay-through securities, there is a stable cash flow because the 200 stable cash flow will keep on happening from SPV to investor. Then there is stripped securities, students. Stripped securities means wherein the entire amount of a security is stripped into 2 parts. So the loan has 2 different repayment, 2 different cash flows, right? One is the interest and second one is the principal repayment. Now this principal repayment, if a security is issued only on the principal amount of repayment, it is called as a principal only security. And there is another type of security. Let me just write here security 1, security 2. So there are 2 different classes of security. Like in equity shares, we have different classes. Here also there are 2 different classes. Security 1 is the first class. Security 2 is the second class. Now, if you have two different security classes and security 2 is having an underlying of only the interest amounts and security 1 is having the underlying only as principal, then these securities are called as stripped securities because you have stripped them into two different parts. The principal one is called as PO, the principal only security, and interest one is called as the IO, which is interest only security. You're getting the point? Now, in our example, 1,000 crore was the loan that was a mortgage loan and it was securitized. Correct? It was securitized. Now, this 1,000 crore, the stripped securities will have two parts. Okay, one, the principal repayments of this 1,000 crore, and second one is the interest obligation on this 1,000 crore. So this is what it is called as stripped security. Now SPV is going to sell interest only and principal only separately in the market. They are going to sell these securities separately into the market. Now there are different investors. Let's say there is an investor who will prefer only the interest only security. There is an investor who will only prefer the principal only security. Now, initially, let's say the interest rate is 10%, the interest only security is 50 rupees, and principal only security is 100 rupees, right? The market interest rate is, let's say, 12%. Okay. So, can we say that the interest only security of 50 rupees was basis that 10%? Now if it increases 12%, the price of this security will also increase from 50 to 60? The answer is yes. So if the interest rate increases, the price of interest only security will increase. Now let's see what happens to the principal only security. Now, principal only security, 100 rupees was the amount and 10% was the initial rate. 12% is the higher rate. So, 100 into 10% divided by 12%. So, it is 83. So, the price of principal only security has come down. So, it is inversely proportionate, right? We have already studied the bond prices are inversely proportional to the interest rates. If the interest rate increases, the bond price decreases with a simple reason. Mathematically, it can be proved here. The initial 10% was quoted as 10%. So 100 on 10% is 10 rupees is what you will get as a contractual cash flow, but that is worth only 12% as on today. So that means your value that you perceive for this 100 rupees of principal only security has dropped to 83 rupees, students. Clear? I hope this is clear, students. Then, as we discussed, bond prices are inversely proportional to the interest rates, or interest prices are the inversely proportional to the bond prices, right? Now, what theory we are driving from here is if the interest rate increases, bond prices goes down and vice versa. Similarly, for principal only securities, it is going to be the case. For interest only securities, if the interest rate increases, the price will also increase. For principal only securities, if the interest rate increases, the price is going to decrease. Clear? Yeah. So, another example now, the market rate has gone down to 8%. Now, 50 was 10%, and the new rate of 8%, if we multiply, will get 40, which is a lower amount. Correct? Because 50 represented 10%. Now, what is the new amount will be multiplied by 8%, which is equal to 40. So, since the rate has come down, so from 10%, the rate has come down to 8%. 50 rupees has also come down to 40 rupees. Correct? Now, if we come to principal only securities, we have 100 rupees. On this, 10% will be multiplied and 8% will be divided. Why? Because 100 into 10% represents the current interest. However, the real perceived value of this is divided by 8%, which is the current one, which becomes 125 students. So, in such case, the principal only securities, the prices increases if the interest rate comes down, which is again holding true with our understanding and theory as well. Okay, I think this we would have discussed something around the cost of equity, right? Here also we discussed that the market price of an equity share is inversely proportionate to the cost of equity, right? Cost of equity is as good as what is expected out of the security in the form of a return. So if cost of equity goes up, the price goes down. If cost of equity goes down, the price goes up. This was a similar relationship, right? Just like interest rates and bond have an inverse relationship, equity share and cost of equity also have an inverse relationship. I hope the discussions are clear till now. I'll take a pause and see if there are some any questions. Okay, students, I'm again asking in case there are any questions, please feel free to ask them during the session through a chat box or any other mode as well. Okay. Now, this is an example on pass through certificates, right? Wherein we are saying that let's say the principal for different mortgages is totaling to 500 crore, 100, 200, and 200. The interest rate is 5, 5.5, and 6. Maturity is 2, 1, and 1. Now, the pass through certificates is going to be a proportionate representation of all these three mortgage loans, correct? Because it will not have its own, um, I would say, the rights and obligations as well as its own different amounts, right? Now, SPV will receive 500 crore from investors. Now, if we see what is the weighted average mortgage loan rate, now there are different rates, right, students? 5, 5.5, 6. So we have to just see that what is the overall interest rate that we can find out. Yes, 100 crore of loan is at 5% out of 500 crore. 200 crore loan is at 5.5% out of the total 500 crore. And similarly, the last 200 crore is at 6% of the overall 500 crore loan. So we just take a proportionate amount. 5.6 percentage is the income of SPV that is going to be minus 0.6% is on account of the operational expenses. Okay. 0.6% is on account of the operational expenses, students, because SPV will also require certain amounts to operate itself in the form of, let's say, the salaries of the individuals who are working in the SPVs, right? Their administrative expenses, all those things. And hence, they will quote 5% as a net pass through rate to the investors, right? So they will just estimate that out of 5.6, 0.6 can cover up our expenses and 5% can become the pass through rate to the investors. Now somebody might ask us that what is your weighted average maturity? For that, again, we will just take the different maturities and take a weighted average multiplication around the same. Clear? So it is going to be 2 years, 1 year, and 1 year. So which is effectively 1.2 year. SPV will propose to investors a return of 5% for 1.2 years. Okay. Now, let's come to the features of securitization. So the features of securitization covers creation of financial instruments, right? So what is happening, students? Through the process of securitization, the new securities are coming into existence, and hence the financial instruments are getting created. Then bundling and unbundling. Why we are saying bundling and unbundling? Anyone would want to attempt this? Why we are saying first bundling and then unbundling? So Prashant have asked a question in pass through. What is the earning source of SPV? Good question. So in pass through certificates, there is no earning source of SPV because SPV is not having a different identity. Correct? SPV is having a similar identity to that of the investors because it is just acting as a pass through. So only 0.6%, which is the day to day running expenses for SPV, it will keep. Rest, it will everything, it will be passed to the investors. Okay. There is no earning that will be retained by the SPV. Now, bundling and unbundling means here, students, bundling was the process of creation of pool of funds. Unbundling was issuing of marketable securities, right? Wherein you are converting the total amount into different denominations. That is called as unbundling. That is the creation of the marketable securities. Bundling means where you are creating the pool of funds. Then tools of risk management. Yes, it can act as a tool of risk management. Remember our recourse and non-recourse discussion. In case it is happening on a recourse basis, then or on a non-recourse basis, then also. Clear? Then structured finance. Structured finance means that on a structured basis, the financing will happen, right? These are a proper form of financing. Trenching. So, trenching means that you are actually creating different risk and reward opportunities for the investors. So, as I said, that there can be different classes of securities, just like equity share. So these are called as trenching because you're creating different trenches. Homogeneity. Homogeneity will mean that the transaction is actually homogeneous. Within one class, the risk and rewards are homogeneous. Okay. Now, if we talk about who are the participants, students. So the entire participants are actually bifurcated into two different segments. One is the primary participants, the second one is the secondary participants. The primary participants are originator. Originator are who? They are the lenders, right? They are the banks who have originated the transaction. SPV is actually the special purpose vehicle, right? Which is paying for the takeover of such loans, and it is also issuing marketable securities. And then finally the investors, right? Secondary participants are obligors. Obligors are the ones who have taken a loan. They are the borrowers. Okay, they are the borrowers, students. Rating agencies are those which are rating the credit worthiness of the loans. Receiving and paying agents are the ones who are receiving the managing the collections part. and they are properly accounting it. Trustees. Trustees are for SPVs who are managing, who are governing the overall functioning of the trust. Credit enhancers are the ones who are actually giving you a credit enhancement related surety, right? For example, they will be insuring you in case some of the default happens. So these are just like insurance companies, right? And I think the overall structurer who will structure every party to the transaction. Now, there are some problems when it comes to securitization in India. The first problem is about stamp duty. Now, stamp duty as a concept, it is applicable on securities sale purchase as well. So now these transactions will involve stamp duty. These transactions will also have an implication on taxation because you are selling your asset. While you're selling your asset, at what amount really you should be taxed for. Then similarly, accounting. In case of accounting, there is no proper standard line, whether it be off balance sheet accounting or on balance sheet accounting or what exactly, right? Whether the loan should continue in the books of a originator or it should not. Then lack of standardization. So what happened in case of a specific example of Air India, they had given a securitization. So they have attempted a securitization by which they had actually tried to securitize their future receivables on a particular segment of a flight, right? So what they said that in time to come we will be collecting thousand of crore rupees from this segment and hence we want to securitize it. So this is a securitization on future receivables, right? So this actually led to lot of standardization issues in the entire securitization process. Then there is inadequate debt market. There is inadequate debt market wherein the debt is not sufficiently sourced for, right? And then there is ineffective foreclosure laws. Now today also, if you take a loan and you want to foreclose it, then in some cases you'll end up bearing a good amount of penalties, and hence this entire structure of securitization can fail because of some of the prepayments related issues and other things. Okay. Now, this is a specific discussion on trenching, students. We discussed, right? Trenching means creating different tranches, different levels. So there are three different levels. One is senior, mezzanine, and junior. So junior is someone like debenture holders. Mezzanine is someone like preference shareholders. And senior is someone like equity shareholders, right? So So yeah, in the below case we have discussed, right? For equity shareholder, there is a good amount of risk, but there is a residual reward as well. Similarly, for preference shareholder, the fixed dividend is there, the reward is fixed, but the risk is also medium. Debenture holders, there is lowest risk and there is a fixed amount of percentage. So these different tranches are also created in the regular securitization process, students. Okay. Then comes the concept of blockchain and tokenization, because this is somewhat similar to the securitization. So, students, blockchain we need to first understand in its name itself. There are two things: one is block, and second is chain. So, it's a chain of blocks. Different blocks are created and they are added to chain. Let's say block 1, block 2, block 3, block 4, and future blocks will be added. Now, these blocks are what? These blocks are pieces of information, and anyone in this platform can add a block after it is properly encrypted and validated by the network provider. and these are all accessible to all the users. This is called as distributed ledger technology, DLT, by which it means that the different users will be able to update these blocks at the similar point of time. That's why it is called as distributed ledger technology, DLT. Just for an example, you know how distributed ledger technology works. Just example, micro Excel, which is a spreadsheet which can be edited by multiple people at the same time, right? So that is called as a distributed update in the Excel sheet that is happening. So this is called as distributed ledger technology, wherein a lot of people at the same time can make changes. Now, in this example, we discussed, let's say there is a block which says that India company is paying to Australian company. What was the balance before payment for both the ends? What is the balance after payment for both the ends? And then there is another block that will get added to this chain. So this will be visible to both Australian and Indian company, and hence it is a transparent mechanism. And these are broadcasted. These blocks will be broadcasted via the network. On these chains are there. Cryptography will be used to validate the transaction. So there is a technology called cryptography. Cryptography is encryption and decryption, right? So they will validate the transaction. Then once it is validated, it will be represented as a block added to the existing blockchain, and then the transaction is complete. So if you see, the actual payment has not happened. The actual payment has not happened. It's just that the information is added in the form of a block, which will give you the which will give you the I would say, which will give you the evidence that the amount has moved. Okay. Now, what are the different applications of a blockchain? Financial services, students. Just now we saw, right? In case of a cross-border payment. Now, I am saying that there are yet these are whether legal methods or not. These needs to be established. But as of now, these are the applications of blockchains. Second is in healthcare. Now, in healthcare, this can be used to keep records, right? Because there are different events in one's life that keeps on happening on a healthcare side. So all these records can be kept on this blockchain. Similarly, government can keep a lot of records, which is on the land registration, which is on the registry records on this. Then there is travel industry. Travel industry, there is a lot of documents involved. For example, passport, visas, other applications. All those can be stored, or all those can be linked using the technology of blockchain. Then economic forecast, wherein there are different factors that are involved. Even those can be used for the blockchain. Okay, because there are different data sets that are there, and there are sequence attached to that. Okay, then risk associated with blockchain. What are the different risks that are associated with blockchain? The members of network, right? They have they that is their responsibility, that the network is operating in the manner that is intended. The second is about the technology. The technology that we are using is a foolproof technology, right? It's not that today we are updating something, but tomorrow it is automatically getting replicated. Absence of central authority, as I was mentioning, that there are no regulations around it. There is no central authority that is governing the entire thing. And then there is a humongous data that keeps on getting generated, students. Right? Now let's come to the concept of tokenization. So tokenization is somewhat similar to securitization. Now what happens in tokenization? It is process of converting tangible and intangible assets into a blockchain tokens. Now here what happens? Let's say there is a very expensive artistic painting that is there. Okay. Now that painting is converted into a digital token which will have a value assigned to it, and those tokens can be bought and sold in the secondary market just like you do for securities. So what has happened here in tokenization? Here also the illiquid assets are converted into marketable securities. Clear? In this case, what are happening against securitization? There are some similarities, right? The liquidity is actually injected into the system. There is a diversification, right? Diversification, and in the form of trading. Now these can be traded, and it will lead to the new opportunities, right? Because you don't need to wait and sell those paintings. Actually, you can just get it converted and then accordingly do the things. Okay. So securitization as a process is this much. Now, what we are going to do, students, we are actually going to do some case studies around it. Case scenario 2. Let it come out. So these have already been uploaded, students, onto the portal. Any questions in the securitization revision that we did, students? Let me just take a pause and check on the questions as well in case there are some. Okay, perfect. So let's come to the case scenario 2, which is around the securitization. Growmore Limited and NBFC is in the need of funds, and hence it sold its receivable to Mac Financial Corporation MFC for rupees 100 million. MFC created a trust for this purpose called General Investment Trust GIT, through which it issued securities carrying a different level of risk and return to the investors. Sorry. Now, if you see, students, this is the point to be noted, that it carries a different level of risk and return to the investors. Further, this structure also permits the GIT to reinvest surplus funds for short term as per their requirement. So it is allowing GIT to reinvest the surplus funds, right? Even this is also validated here. MFC also appointed a third party, Safeguard Private Limited, to collect the payment due from obligors and pass it to GIT. That is also fine. It will also follow up with defaulting obligor and, if required, initiate appropriate legal action against them. From the information given above, choose the correct answer to the following questions. The securitized instrument issued for 100 million by the GIT falls under the category of. So it pass through certificates? Is it pay through securities? Is it stripped securities, or is it debt fund? Yes, Khushi, you are correct. The answer is correct. So this is going to be the pay through security, and the reason is because these two lines are giving you an indication that the risk and return of these investors are totally different to the risk and return of the SPV. And SPV is also allowed to invest, right? In the above question, the originator is Who is the originator here? Come on, students. Who is the originator here? The originator means the bank. So, Mac Financial Corporation is the SPV, not the originator. The originator is Grow More. In the above scenario, the GIT is an. No, wait, sorry, my bad. This is Mac only. SPV is GIT. So the originator is MFC only, because the MFC is actually creating a SPV and it is originating the transaction. So you're right, Khushi. MFC is the originator. GIT is an SPV, right? Because the GIT is actually creating the securities that are being issued, right? So that is the purpose of GIT for which it has been enacted. In the above scenario, the safeguard is an. The safeguard private limited is what? This is an easier one. Yes, receiving and paying agent. Very good. Which of the following statement holds true? When yield to maturity is what, students? Interest rates. In market rises, the prices of principal only securities tend to rise. When yield to maturity in market rises, the prices of principal only securities tend to fall. When yield to maturity in market falls, the prices of principal only securities tend to fall. When yield to maturity in market falls, the price of principal securities remain the same. So they are talking us that once the yield to maturity is changed, the concept says that the opposite movement happens in the price principal only securities. So yes, you're right, Khushi. This is the second option, wherein we are saying that when the interest rate rises, the principal only tends to fall. Yeah, I think this was it from securitization point of view. Now let's come to derivatives, students. Let's start with the next topic on derivatives. So derivatives, yeah, let's start with the next topic. So derivative, students, we have again actually discussed in detail in the, I think, 5 sessions maybe. So I will try to summarize the entire discussion in, let's say, probably today's session and somewhat in our next session. Okay. So derivatives, students, we discussed that derivatives is a financial instrument which derives its values from an underlying. Now that underlying can take different forms. It can be a commodity, it can be an equity of X Limited, it can be a foreign exchange, it can be an index, right, which is a Sensex or Nifty, or it can be weather, right? Then we said that whatever is the case, there are some basic characteristics of a derivative. First of all, there is a buyer and seller to the derivative, right? Without a buyer and a seller, without parties to the derivative, the contract will not be made. As we said, that derivative is a contract, right? So the buyer will buy the derivative and seller will sell the derivative. And we said that the buyer and seller of derivative will be very much different from the buyer and seller of the underlying. Now, if we take an example of an equity share as an underlying, the buyer and seller of equity share will be different compared to the buyer and seller of the derivative. The value of derivative is actually dependent upon the value of the underlying, and hence the value is derived from the underlying's value. There is a fixed tenure of A, which is the derivative in our example, right? It has to be a time bound instrument. It can be for 1 month, 2 months, 3 months, up to that. Then there is a settlement that is required to happen. So settlement means that on a net level, the payoffs will be either paid or received by the buyer or seller respectively, or actually the gross settlement will happen wherein the assets will be delivered and the cash will be received, right? So if you see, there are some parts which are fixed and certain, and there are some factors which are uncertain. So there are, what are the certain things? The underlying is certain, the quantity and quality is certain, and the time period is also certain. What is uncertain? The prices of derivatives is uncertain. Sorry. Sorry. So if you see, students, these basic characteristics are going to be similar whenever we are going to talk about forwards, whenever we are going to talk about futures, and whenever we are going to talk about options. These basic features are not going to change. And let me also remind that A as a derivative has a very distinct identity when it is compared to the underlying. It's not a similar thing. A is totally separate and B is totally separate. So A derives its values from B. Okay. Now let's come to the first type of derivative, which is a forward contract. Now here we took an example. Here we said that there is a procurement manager in a company, and the procurement manager wants to purchase a crude oil. Even the grade is also specified, grade A, 20 liters. Okay, but the delivery is required after 6 months from today. The purchase is not for today, the purchase is happening after 6 months from today. The today's price is 100 rupees. After 6 months the price is likely to go up. So what will happen? The procurement manager will go to the supplier and say that, okay, can we lock the price as on today for the deliveries that you can give me after 6 months at 110? The supplier says, okay, that we can take this into a contract. So now the contract becomes the supply of 20 liters of grade A crude oil, and procurement manager will pay the price of 110 per liter. Now what happens, students? After 6 months, let's say the actual price has moved to 115. Let's talk about this first. 115. Now, if the actual price has moved up to 115, the negotiated price was 110. So, from procurement manager standpoint, he has already agreed to purchase at 110, and the counterparty has also agreed to it. So the 5 rupees, the actual price, what is higher in the market compared to the negotiated price, this will be a gain to the procurement manager, right? With a simple reason that had this negotiation not been done at 110, the procurement manager would have purchased the oil at 115, which is the market price. Correct? So this is leading to a 5 rupee benefit with the procurement manager. Similarly, if the price has gone down to 95, the negotiated price is 110. Now tell me, students, had this negotiation not has happened, the procurement manager would have purchased at 95, but now there is no option to purchase at 95 because procurement manager has already entered into an obligation at 110. So effectively it means that 15 rupees there is a loss to the procurement manager because of this contract being entered into, because now the purchase will happen at 110, which is 15 rupees higher than 95. From a supplier side, 15 rupees there will be a gain, students. Why? Because supplier would have realized 95 had supplier not entered into this. But since supplier has entered into this, the supplier will get 15 rupees extra. Instead of 95, the supplier will get 110. So that is where the gain will be there. Correct. So this is how the gain or loss is determined. Now, if you see procurement manager is into the buying position, right? And supplier is into the selling position. So the supplier will incur a gain if the actual price has come down compared to the negotiated price, which is the second case. The buyer, which is the procurement manager, will gain in case the actual price goes up compared to the negotiated price, because now the procurement manager will be able to avoid such situations. I hope I'm clear, students. So, whether you gain or lose is really determined by two things, right? One, what is the actual price in the market compared to the negotiated price? And second, what is your position in the deal? If you are in the buying position or you are into the selling position. If you are into the selling position, it is always beneficial if the price goes down, because if the price goes down through this contract, you will gain. Although in the open market, you are not gaining if the price goes down, but through this contract, you will gain. Okay, perfect. Now, settlement, how it happens for a forward contract. Now, the settlement can happen in two ways. One is on a gross basis, and second one is on a net basis. So, after 6 months, this is a gross basis settlement. The procurement manager will pay 20 liters into 110, and the supplier will deliver 20 liters of crude oil to procurement manager. Okay. Now, if we see the forward contract, over the counter contract, it's happening on a gross basis. Futures. Okay. So, okay, let's conclude on the forward contract discussion. Forward contracts are settled on gross basis and they are over the counter contracts, which is called as OTC contracts. Why? Because these are customized. Okay, these are customized contracts. Now let's come to futures, students. Futures are also similar to forwards. Here, the buying or selling of the underlying will happen in future, but we are entering into the contract today. Now, the essence of forward contract was what? The forward contract was getting entered today, but the sale and purchase, or let's say the execution of the sale and purchase, will happen in a future time, which is not today. Correct? So, in case of a futures also, the actual execution of the sale and purchase will happen after 6 months, 7 months, or let's say 1 year. But the agreement to sale or purchase is happening today. Now, the difference between futures is and the forwards is that the futures are very much standard contracts. Right here, you cannot change the quantity that is specified in the contract. You cannot change the quality that is specified in the contract. These are settled on net basis. So that means the gross basis settlement is not possible in futures because futures are traded on a stock exchange. And hence, while you are trading on a stock exchange, it will not be possible for you to go and deliver, let's say, the crude oil to those parties, right? And hence, the forward contracts are always settled on gross basis. These are always customized. So, for example, futures will say that always the lot size is going to be 100 units. But in case of forwards, you want a smaller lot size. In case you want a 50 units kind of a forward contract that you can enter through this. Okay, that you can enter through this. But futures doesn't permit that because futures, these are standard contracts that are traded on a stock exchange. Okay. Now, let's take an example. In this case, let's assume that the equity shares of X Limited are acting as a underlying. Okay, equity shares of X Limited are acting as an underlying. Case 1, prices are going up in the time to come. If let's say you are of the view that the prices are going to go up in the time to come, what you will do? Will you buy the future or will you sell the future? The answer is you will buy the future because if you are into the buying position, if the prices goes up tomorrow, you will gain. We just now saw, right, in the procurement manager's example. Similarly, okay, let's take this. If let's say today is 100, 120 it goes. So 100 you have purchased and you will sell at 120, you will gain 20 rupees. Now, if the price is expected to go down in the time to come, what you will do? You will sell the future, right? You will not buy the future, you will sell the future for the simple reason that today the price is higher, tomorrow the price will be lower. So today I'm selling and tomorrow I will purchasing it. Okay. Now, this actually explains. So buying means long position, selling means short position. So today the price is 120 and it is expected to go down to 100, right? Then what will happen? We will do a short selling. Okay. So short selling, this concept is called as short selling. Short selling means today you are selling what you don't have, and after some time you will purchase it back, whatever you have sold. Okay. Now, in underlying market, which is the cash market or spot market, the long position is allowed. Yes, it is allowed. Is short selling allowed? The answer is for intraday it is not allowed. Intraday it is allowed. That means within the same day, if at 10 a.m. in the morning you sell and 3 p.m. in the noon you purchase it back, that is allowed because that you are doing within the same day. But interday it's not allowed. Let's say today you sell and after 4 weeks you purchase it back. That is not allowed. Okay, this is about the cash market, the spot market we are talking about, not the derivatives market. However, the futures and options market, the F&O market, which is a derivative segment, here the futures So options we have not covered yet, but for futures, if we discuss, the long position is also allowed, and even the short position is also allowed, students. Okay, so in case you feel that the prices is going to go down, you can do a short selling in derivatives market on futures. Okay, clear? So the futures are totally delinked to the underlying. Okay, that's what we are saying. The buyer and seller will be different of the future when it comes to the buyer and seller of the underlying, students. I hope this strategy is clear, students. The two different cases where the prices is going to go up and the prices is going to go down. Clear? Perfect. Now, there is a cash segment which is called as the underlying. Then we discussed about the forwards contract. We discussed about the futures contract. Forwards contract are OTC, highly customized. The accrual basis is 100%. The actual basis, the gross 100% settlement will happen. On futures, these are very much standard contracts. These are traded on a stock exchange and they are due for the net payoffs. Okay. So this was there around the conceptual part of forwards and futures. Is there any question, students? Let me pause for a time being and ask. In case, is there any other question you want me to answer? Okay. So let's take a break uh, of 10 minutes and then again we will be reconvening on the other parts of the derivatives. Yes, Manisha. Okay. So students, welcome back. We have discussed about the forwards and futures concepts. Now let's talk about the pricing methodology for the forwards and futures. So pricing, students, if we want to understand about the forwards and futures, first we need to understand how the future value and present value is computed using the compounding method, right? So it's just a simple calculation that we all have done till now in different parts of the concepts, right? So compounding means that A, which is the future value, is equal to the present value into 1 plus r raised to the power t, right? So this becomes the 1 plus r rate of return whole raised to the power t, which is the time period. This becomes the annual, the future value, right? Semi-annual compounding, students, it has to be divided by 2, right? The annual rate of r has to be divided by 2, and the period of time period will be twice multiplied to arrive at the 2 times of compounding. So this gives us the formula wherein A is equal to P1 plus R divided by N raised to the power NT, where N is basically the number of compounding in a year, like semi-annual compounding, quarterly compounding, monthly compounding, all those things. Discrete, this is called as discrete compounding. Okay. Discrete compounding is something which is not a continuous compounding. It is compounded in a different way, right? So this is a simple formula on the future value, students, right? R is equal to the rate of return. These are compounded quarterly. Okay, so A is equal to P 1 plus 10% divided by 4 raised to the power 4 into T. Okay, so this is a quarterly compounding case. So quarterly compounding case for 3 years, the time period will become 4 into 3, which is 12 in totality. Correct? Okay, so this is what the discrete compounding is. Now let's come to the continuous compounding, students. Now continuous compounding means that the compounding is happening every now and then. That means every millisecond the compounding is happening. That means n is actually infinity. Number of times compounding in a year is actually infinity. So which gives A is equal to P into E raised to the power R T, which is the continuous compounding, students. So here E is used as an exponential function, and that is multiplied into P to arrive at the overall future value. Okay. Now if you talk about, okay, let's complete this first. So A here represent the future value, P is the present value, R is equal to the percentage per annum. Time period for 1 year, T is always assumed to be 1, and E is the exponential function. Okay. Now, the valuation of a forward or a future is actually the future value of the spot price. So there is a spot price that is there. This is always deemed to be the present value. Correct? The spot price that is appearing today is always deemed to be the present value. If you calculate the future value of the spot price, you will be able to calculate the future value of the forward, or the forward price, or the future price, whatever you want to call. So the price of a forward or future is equal to the future value of spot price. This is very simple. Let's say today the spot price is 100. The future that we are calculating a value is for 6 months. So that 100 rupees future value of 6 months will become the price of the future of 6 months. Okay. And here the expiry, which is denoted, will be used as a time period for calculating the future value. This is a case of discrete compounding, students, right? Discrete compounding basically will mean this formula that we discussed above, right? In this case, the compounding is happening at n times in a year. For every n break, the compounding is happening. Continuous compounding, students. continuous compounding, A is equal to P into e raised to the power RT, where the spot price is there, and then for different months expiry, there are different prices that are coming out to be. Definitely, the 1 month future price will be lower, 2 months future price will be higher, and 3 months future price will further be higher. Okay. Now, treatment of dividend and transaction cost. Now, now what happens while you have a spot price today, you'll have to adjust for two more things. One is dividend and one is transaction cost. What is given in question will have to be adjusted for. In case of a discrete dividend, okay, in case of a discrete dividend, that means that dividend is paid on a specific date. So what we will have to do, we will have to first calculate the spot price minus present value of dividend. This is the ex dividend spot price. I hope all of you agree to me, right? Multiplied by 1 plus r divided by n raised to the power tn. So this is the n means the number of times the compounding is happening in a year. Similarly, if there is a transaction cost element, that will get added. The present value of transaction cost will get added to the value. Okay, multiplied by 1 plus r by n raised to the power tn. So this formula, what it is saying, you just take the spot price, add present value of transaction price into that, reduce present value of dividend from that, that you take as the present value, and for that present value you calculate the future value. Okay, so here A is equal to, this is the present value here, multiplied by e raised to the power r t. This is for the continuous compounding, students. So wherever e raised to the power rt is functioning, that is used for the continuous compounding. Okay, continuous compounding from the interest rate standpoint. But this present value of dividend means that the dividend is discrete. Okay. Now there can be a situation of a continuous dividend, students. So you would have seen that some way or the other, there is a dividend is also expressed as, let's say, 20% dividend yield. If you analyze any financials, right, or a stock, let's say they say that dividend yield is 20%. That means on an average for a full year, the company is paying 20% dividend, right? So this is a continuous dividend case. Now you cannot do the present value of dividend against this 20% dividend. You will have to take this formula wherein A is equal to P into e raised to the power r minus y multiplied by t. So here r is your regular rate of interest through which the compounding is increasing, and y is basically the dividend yield against which the compounding will decrease, which is this. And this formula is very important. This has to be understood. This has to be retained because this is mostly widely used formula for calculating the future value. Clear? So another point, on expiry, the future price will become the spot price because now there is no future value and the present value difference, right? There is no difference on account of the future value and present value. That means there is no interest element involved now. Clear, students? So this chart actually shows that as we move towards expiry, expiry is on x-axis. The closer we move towards expiry, the difference in future price versus spot price. Okay. So the y axis tells you that what is the difference between the future price and the spot price. That is actually collectively moving down and it becomes zero. So that on expiry, the spot price becomes the future price as there is no interest portion left. I hope the point is understood here. Okay, so just to sum up, students, the pricing of a forward or a future is actually the present value and the future value, right? Present value is the spot price. The price of a forward or a future is actually the future value of that spot price. But in that case, we will have to adjust for dividend and transaction cost. Reason why dividend is getting adjusted? Because dividend you never pay on a derivative. You never pay a dividend on a futures or forwards. You will only pay dividend on the equity share that you have actually issued. Hence, we reduce dividend, what is given in the question, and transaction cost is always added because if you today, for carrying out your derivatives, if you have to purchase a share, you will have to incur a transaction cost and it will really influence the cost at which you have acquired that share. Clear, students? Further, we discussed that we will have to keep in mind about two major things. One is about the continuous part, and second one is the discrete part. Now, the compounding can be continuous, in which case we will make use of exponential function. The other case can be a discrete compounding where we just need to multiply basis the different intervals. What is the compounding rate that is coming out to be, students? Clear? Now, let's discuss about some of the uses of derivatives, students. Okay. Now, uses of derivatives, the biggest one is, or rather, I would say, one of the main use of a derivative is speculation. So, speculation means that you have an expectation of a price going up or a price going down. Speculation means there is a hope of gain or there is a risk of loss. If you expect that the price is going to go up, then what will you do, students? You will purchase the purchase the forward or future. Till now, we have studied about forward and future, right? If tomorrow the prices is going to go down, you will sell the future. You will sell the forward, right? Because short selling is allowed in derivatives. So as we discussed, right, long position futures of X Limited, you can take short position against futures of X Limited, you can also take that, right? Then there is a margin on 80,000 rupees at the rate of 20%, which is 16,000, which will get deposited, right? Because in a stock exchange, if you have to deal in futures, you will have to deposit a margin. In this case, we have assumed to be 20%. Now, on expiry, what will happen? You have entered at the rate of 80, right? The long position, if let's say the actual price comes down to 70, then 70 minus 80 into 1,000, which is actually minus 10,000, right? It's a loss. because the actual price has come down. You have contracted to purchase the asset at 80. The actual market price is lower by 70. Now, what will you do? You will end up executing the transaction as 80. So that means 10 rupees loss will have to be borne by the person who has entered into this contract, and hence there will be a loss of 10,000 on 1,000 contracts. Okay. But 16,000 you have given as a margin, so you will get back only 6,000, right? Now, if let's say the price has become 90 on expiry and you have taken a long position, that means you are gaining 10 rupees, right? Because had you not entered into the contract, you would have ended up purchasing at the rate of 90 from the market. But because of this contract, you are able to purchase at 80 rupees. So 10 rupees you are getting a benefit. So 10 rupees on 1,000 units will give you a 10,000 kind of a benefit, and 16,000 you will get back. So in totality, you will get back 26,000 rupees. Clear? Then, if you have taken a short position, students, short position on expiry, if let's say the price has become 90 rupees. So the way it will happen is you have contracted to sell at the rate of 80 rupees, but actually you can sell in the market at 90 rupees. But because of this contract, you will end up selling at 80 only. You cannot sell it at 90 because this is a contract that you have entered to sell at 80. And hence, what will happen, students? You will incur a loss of 10,000 rupees, which is 10 rupees on 1,000 units. Okay. And on expiry, the 70 rupees is the outcome. Then you will be able to sell 80 rupees for something which is valued in the market at 70 rupees. That means you're able to realize 10 rupees more here. So that means you will gain 10,000 rupees plus 16,000 you will get back on account of the margin that you have given. So 26,000 you will get as is. So in a nutshell, students, what is happening here? If you take a short position, prices goes down, you gain. If you take a short position, prices goes up, you lose. In case of a long position, prices goes up, you gain. In case of a long position, prices goes down, you lose. Okay. Then comes hedging. Okay, so the hedging is actually protection against the risk. So that one was speculation. This is hedging now. Now, hedging is basically that you are already exposed to a risk and you're trying to protect yourself against that risk by using forwards or futures. How? So as we discussed, this is already against a risk and this will be protected against that risk. How? The risk of holding equity shares in spot market. Right? In case you are holding equity shares in the spot market, what is the risk that you are holding? The risk is the risk that the prices will fall down. See, if you are holding an equity share in the spot market, if tomorrow the price increases, you will gain. Correct? But if you are holding equity shares in the spot market, the risk is that the prices will go down. Now, if the prices will go down, you will have to devise a strategy by which you gain in case the prices goes down. That can happen only if you sell the futures, right? As a hedging strategy. If you buy the futures, that means you are increasing your risk, because in the spot market also you are purchasing the shares, in the futures market also you will purchase the futures. That means you are increasing your risk. However, in case of sell futures, you are not increasing the risk. You are rather playing against the risk, right? Now, if the prices actually goes down, then what will happen? In the spot market, you will have a loss, and in the futures market, you will have a gain. Okay, so the loss will be offset by the gain in the futures market. This is what the hedging is, right? So hedging is basically it is exposed to a risk, hedging against that risk by using the forwards or futures. Clear? Now, if we talk about the example here, so let's say there are 100 shares being purchased at the rate of 300 per share each in the spot market. There is a risk of prices going down, students, right? Now, against that, what you do? You do a futures market short position of 350 per share. Futures at the rate of 350 per share. Now, what will happen, students, here? Closing price is 300, 350, and 400. We have taken different cases. Now, if let's say the closing price is actually lower, then what will happen? First of all, in the initial bid, you have purchased 30,000 rupees in each case, right? About the shares. And you have also deposited the margin of short selling at the rate of 7,000. So your initial cash outflow is 37,000 in all the cases. Okay. So the initial cash outflow is 37,000 in all the cases. However, the sale proceeds will be different according to the different prices. Now, the first case we have assumed 300. So you will sell the shares at the rate 300, but at the futures position, you will have a gain of 50 rupees, right? Because you have sold it at 350, the closing price is 300. That means 50 rupees gain will be there. So you will end up recording the gain, right? So 30,000, you will get the margin back and you will get the 5,000 gain. Correct? In case the price is 350, you will get 35,000, which is 100 into 350. You will get a margin of 7,000. Gain loss will be zero. In case the price is 400, you will sell 100 units at 400, 40,000 you will get. You will get your margin back. However, you will incur a loss this time of 5,000. Why? Because you have entered into a short position at 350. The actual market price is 400. The prices have gone up. That means you will incur a loss of 5,000, students. But in all the three cases, your total cash flow is 42,000. That means 5,000 each you will end up spending, you will end up getting from your investment, and hence the future selling price was 350. The purchase had happened at 300. That means 50 on 100, 5,000 is what we would have gained. And the example is also showing the same thing, right? So, what has hedging done for us? Hedging has actually created a fixed outcome of getting the profit at 5,000 rupees, students. Okay, so there are no different. So there are no different values that are coming out. Okay. So Khushi is saying, if possible, take question 14 of TYK from study material. on page 9.68. Okay, initial margin and maintenance margin. Okay, let me go to that. Page number you are referring as 9.68. Okay, 9.68. Question number 14. Okay, I think here the catch was about the maintenance margin. Okay, let me just share the screen. So the question number, okay, we'll just follow this. Question number 14 on page 9.68 of the study material from Test Your Knowledge. Okay. So here the question is about, okay, let me explain the question and then we'll come to the solution part. Here the question is talking about the Sensex futures, students. Now the Sensex futures, first of all, are those which are having an underlying as Sensex, right? As we discussed that the futures will have underlying of equity shares. Similarly, they can have an underlying of the Sensex, which is the index itself. Now they here we have been given for 10 trading days what is the high, low, and closing rates, right? And against that, Abhishek bought one Sensex futures contract on February 4. The average absolute change in the value of the contract is 10,000 and standard deviation of these changes is 2,000. So they are saying that the mean of the changes is 10,000 and standard deviation of these changes is 2,000. The maintenance margin is 75% of the initial margin. You are required to determine the daily balances in the margin account and payment on the margin calls, if any. Now, what happens, students? See, initial margin is actually set up using one formula. Okay. Basis the facts that are given in this question, there is a formula to calculate a initial margin, which is actually the daily absolute change, which is the average change plus 3 times of standard deviation. So initial margin is actually given by mean plus 3 times standard deviation. I can explain this why this is taken as mean plus 3 times standard deviation. I'll explain how. So students, what happens? There is a standard normal distribution table. Okay. There is a standard normal distribution table, and the characteristic of the standard normal distribution table is 99% of values appears in this range. Sorry. Yeah, 99% of the values appears in this range, which is just a second. Yeah. Minus 3 times standard deviation. So if this is the range and this is mean plus 3 times standard deviation. So they mean to say that more than 99%, not 100%, but somewhat almost close to 100% of the values will appear within this range, and hence whatever is your outcome, if you operate within this range, you are able to predict that 99% of the time you will be secured. So using this, they have kind of calculated an initial margin which will cover up for different scenarios of losses, which will at least cover up 99 point something percentage of the losses, right? So that is where the initial margin is quoted here. Okay, now if you see what is the 3 times standard deviation was 2000. What was the initial amount of change? Absolute change was 10,000. So that means 16,000 becomes the initial margin. And maintenance margin will mean that after you the transactions are getting executed, if at any given point of time you need to have 75% of 16,000 into your account, which is actually 12,000. Okay, so at any given point of time, basis the actual position in the market, whatever portfolio you are having, if I reduce or add the loss or gain on your portfolio, the closing balance should never go down 12,000. The moment it goes down 12,000, you will again call for the money and make it up to 16,000 back. Okay, so the trigger is if balance comes down below 12,000, then further amount required for making the balance up to 16,000. Clear? I hope, Kushi, this is clear to you. So this is the main part of the solution. Okay. So the significance of the initial formula of the initial margin. So what happens, as I said that, so this is mean and this is standard deviation, right? So mean plus standard deviation, mean plus 3 times of standard deviation represents that you are covering yourself for more than 99% of the situations, not 100%, but more than 99% of the situations. The moment you say that, see, how will you determine the initial margin? You will say, I don't know, it can go up to this much, it can go down up to this much, right? Because you're talking about derivatives, it can be a steep increase, it can be a steep decrease as well. But if you have historical data using which you can carry out a trend, so the normal distribution table is, you can consider this normal distribution table as the collection of the data, historical data that you have, basis which you have arrived the mean and standard deviation. Now the characteristic of this distribution table suggests that if you take mean plus 3 times of standard deviation, you will be able to cover up yourself for 99% of the situations. Now let's say tomorrow the prices increases or decreases. So there is a 99% likelihood chance that 16,000 will be your maximum loss. You're getting my point? So hence 16,000 we should ask you as the initial margin. Clear? Okay. Sorry. Now we discussed about this formula as well, wherein we said that the future value is dependent on present value, multiplied by e raised to the power RT. There is a different way to write this formula as well, wherein if we have to calculate the present value, we will take the future value and we will divide it by the e raised to the power RT, students. Correct? And hence P becomes A, which is the future value multiplied by e raised to the power minus RT. Clear? Then we started about some of the questions. So these questions were more or less around the hedging and speculation both. Right? See, hedging derivatives are widely used for hedging, right? Because you have to curb the risk that you are carrying in your financials and your day-to-day operations, right? Perfect. Now let's come to this. Now let's come to the operating model of your hedging. The operating model of hedging will mean what? Protection against the risks that an entity is exposed to, right? This is what we call as hedging. Let the slides turn down. Let me take a second to check the question handles as well. Okay, there is nothing as of now. Perfect. So let's start around hedging. So we'll take our discussion one step ahead on hedging. So students, hedging means that you are protecting yourself against a risk, right? Now that risk is already existing with you. Using hedging, you are taking an opposite position to curb the risk. Now, how you can do that? See, if we talk about X Limited's equity share in the spot market or in the cash market, you have already long there. So the way you can curb this in the futures market is by taking a short position, students. Right? You will take a short position in the futures market to check for the hedging. Then, in case, let's say, in the spot market, you have a short position, then you are supposed to take a long position in the futures market, right? That means you have to take a opposite position in the futures market, students. Okay. Then there is a hedging possible of X Limited's equity share in the spot market against the index futures as well. So all of you know, students, that index is what? Sensex or Nifty, or let's say the collection of securities in the market. Now, individual share is linked to the index by the way of beta, right? Beta is the element which links these from the index. Now, if beta is 1.2, what does it mean? If market is increased by 1%, X Limited will increase by 1.2%. That means the change in the prices of X Limited will be 1.2 times the change in the market index. Similarly, if beta is zero point 0.8, if market index goes up by 1, the X Limited will only go up by zero point 0.8. Clear? It will only go up by zero point 0.8. So, can you link the risk of your equity share through beta and take a position in index futures? Yes, you can do that. Now, if I ask you what is the formula, then if you are taking the same stock in the cash and derivatives market, take equal and opposite position. Simple. Take equal and opposite position. If you are taking through market index, this is actually very, very important. If you want to take a hedging using a market index, then what you will do, you will take the existing beta and from that you will reduce the required beta multiplied by the value of portfolio and whole divided by the value of the amount, that value of the hedging that you want to do. So here you will have to relate the betas as well. Now, for example, the question sometimes says that you have 1.2 beta, but you have to do a hedging in such a way that your beta is reduced to zero point 0.5. Then what you will do, 1.2 here and zero point 0.5 here. That means zero point 0.7 beta you have to treat for it. By treating, we mean that you have to take a short position or in the long position in the index futures, right? Clear? Now, if in equity market you have taken a long position, what will you do in index futures, students? Index futures, it depends what is your beta. If your beta is positive, then you take the opposite position in the index market. For example, if you have a long position, you take a short position, because then only using that opposite position you will be able to curb the risk. In case you have a short position, you take a long position in the index market. Clear? However, if beta is negative, sometimes the beta can be negative. Beta negative means if the market increases by 1%, the stock will decrease by the beta percent, by the 1% multiplied by beta factor. You're getting my point. Already they have an opposite relationship. The index and the share is already having an opposite relationship. That is what is called as beta being negative. Then in such a case, what you will do? You have taken a long position in X Limited. Index futures, also you take a long position here. If you have taken a short, you take a position. Why? Because the movements are automatically opposite. Clear? So this is how the hedging part is taken care of, students. Any questions, any doubts, students? Now, we discussed that hedging can happen through own equity shares or through index futures, right? In case it is happening through own equity shares, it is very easy. You take the equal and opposite position. If it is happening through index futures, then you take the beta into cognizance, and using the beta, you arrive at the value that you need to take into account. Now, a catch here is if beta is positive, you take the opposite position in index futures. If beta is negative, you take the same position in the index futures. I hope the situation is clear. Okay, perfect. Now, sometimes students question indicates theoretical Nifty futures price. I mean, it will ask you what is the theoretical value of the futures. Theoretical value is basis the formula that we have calculated. That is called as the theoretical value. Yes, so this is what we were trying to explain. Okay, let the slides change. Let me meanwhile quickly check in case of any questions if there are any. Perfect. So, in case there is a long position, we have purchased at 100 rupees something, right? If the prices increases to 120, we always gain. If the price tomorrow decreases to 90, we always lose. Correct? That's the simple objective. Correct? The same thing is holding true for a forward or a future also. If you are into the long position of a forward or a future, if the price increases, you gain. If the price decreases, you lose. In case of a short position, today you sell at 100, tomorrow the price increases. If tomorrow the price increases, you lose. Reason, the reason being that you have sold at a lower price. Now you will purchase at a higher price. Now, if you have sold at 100 rupees, tomorrow the price becomes 90 rupees, then you will gain. Reason? Because you will now purchase at 90 rupees. Okay, so this is the limited point that I'm trying to make. So this was fine. Okay, perfect. So I think this is the last point when we will be finishing about the forwards or futures. Perfect. So this is again discussion around one more strategy about the overpriced or underpriced. So overpriced is what? Overpriced is something which is, let's say, the correct value is, it should be 100 rupees, but the market is quoting 120 rupees. You will say that as an overpriced, right? Let's say today the correct value of the land is 1 crore, but the market, the way it is quoted is already 1.2 crore. Then what do you do? You will say that okay, it is overpriced. Whosoever is holding it, sell it. Because in market you will be able to realize 1.2 crore, which is higher, which is premium than what its price should be. So if the future is overpriced, what will you do? If you feel that the future is overpriced, in market the future is getting traded at a higher price, you will sell the future, or that means you will take a short position in futures. And while you will take a short position in futures, for protecting yourself or hedging yourself against the risk of price going up, you will have to take a long position in the spot market, students. Taking a long position in the spot market will mean that if the prices increases, then you will gain. For taking a long position in spot market, you will have to purchase the share. For purchasing the share, you will borrow money for taking the long position. Okay. So this is the arbitraging that can happen. If future is underpriced, what will you do, students? You will take a long position in futures market. You will take a long position in futures market. The moment you take a long position in futures market, you will have to take a short position in spot market to actually curb the risk. Now, the moment you take a short position in the spot market, can you take the short position first of all in spot market? The answer is no. Why? Because you cannot sell the shares on an intraday basis. So then what you will do? You will borrow one share and sell it in the spot market, and then later on purchase the share back and return the shares back to the person from whom you have borrowed it. Clear, students? Now let's come to the options. Okay, now let's come to the options. Now, options, students. See, forwards and futures are those contracts which create a mandatory obligation either to sell or to purchase. Okay, those are mandatory in nature. Options are the ones where you get an option. Okay, now let me explain the options. There are two options, first of all. One is call option and second is put option. Let's discuss about the call option first. Okay, so call option is an instrument which gives you a right, privilege. There is no obligation, there is no mandate of what? To buy. Okay, call option to buy. To buy what? An underlying asset, right? The underlying asset will be specified in the contract that what underlying asset we are talking about. In this case, let's take an example of X limited equity share again. So, first of all, students, A is a contract, okay, or is a financial instrument which gives a right, which gives a privilege. But please hear me out, it's not an obligation or it's not a mandatory thing. It is a right with you. I mean, if you want to purchase, you purchase. If you don't want to purchase, you don't purchase. That we leave up to you. You can assess that. But in case of a forward or a future, it's not a choice. You will have to purchase. In case the price is in case the price is favorable to you or unfavorable to you, still you will have to go and purchase it. That is there for forwards or futures, right? But in case of an option, there is an option with you to buy or not to buy. Okay. The underlying asset at a specified price. That means at a specific price, which is the exercise price or strike price. At that price, you can purchase at an agreed date or up to an agreed date, right? At an agreed date means that on a specific date, you have an option to purchase, or up to an agreed date means, okay, up to 3 months, you have an option to purchase. So, at an agreed date means on the end of the third month, you have an option to purchase. This is called as an European option, where you are given an option to purchase at the end, is called an European option. Up to an agreed date, if you are given an option to purchase, this is called as an American option. Clear? So this is called as call option. So A is a right to buy X Limited's equity share priced at 100 per share on 90th day from today. Okay. Or A is a right to buy X Limited's equity shares priced at 100 per share up to 90th day from today, any day up to the 90th day. It can happen. Okay, so this is American option. This is European option. Okay, so let's say 24th September, there is a right to buy at the rate of 100 on 10th of October. So 10th of October 25 it comes, then what are the different possibilities? We are talking about right to buy at 100. Let's say the actual price moves up to 120. Now you suggest whether you would want to purchase this or not. The answer is yes, you will want to execute the right to buy, which means you would want to exercise the right to buy. Sorry. In the second case, if the actual price has fallen down to 90, so Now you have a right to buy the asset at 100 rupees for which the market price is already 90 rupees. Do you think it's a right anymore? No. You can just go in the open market and purchase it at 90. Why will you exercise the right to purchase at 100? Because otherwise you will end up losing here, right? So you will not purchase the asset under this option. Clear? So you will not exercise the right because it's not a right anymore. Now, what happens, students, in case of an insurance companies? Insurance companies says that tomorrow, if there is a risk that gets executed upon you, you give me a premium today and I will protect you against the risk. So they charge premium. Similarly, in this case, the person who is buying the right will pay a premium to the person from whom the rights are bought. Always do remember, students, options are rights. Okay? These are rights. Clear? Now, if we go further ahead on put options now. Yeah. Any questions, students? Perfect. Now, if we come to put options now, put options, let's take an example as B. B is actually the contract or an instrument. It's a right or an option, but it's not an obligation, not a mandate to sell, right to sell the underlying asset. Okay. Right to sell the underlying asset at a specified price at an agreed date or up to an agreed date. Right. Now, here the only change matter is the right to sell. There it was a right to purchase. Here it is a right to sell. Sell what? Underlying asset. Okay. The strike price or a specified. So this specified price is also called as strike price, specified price, exercise price, by whatever name you want to call. So this is at an agreed date, again European option, up to an agreed date, American option, students. Now let's again take an example of right to sell. If you have executed a right to sell at the rate of 100 on 10th of October, let's say then the actual price comes out to be 80 or 120, then what will happen? So if let's say you have a right to sell at 100, the actual price is 80, then okay, let's understand. It means that you can sell at 100 rupees, but in case you want to sell in the open market, you can only sell it at 80 rupees. So that means you will exercise your right to sell at 100 rupees, correct? That means it's beneficial for you. So it's a right for you which you will be exercising it. So the decision is to exercise the right because it's a right for you. Now, case two, let's say the price is 120. In case the price becomes 120, that means you can go and sell in the open market at 120. Against this option, you can only sell at 100. That means you will exercise the right or not. It's not a right anymore. You can just go in the open market and sell it at 120. So it's not a right anymore. We can just go and execute it in the open market at 120, students. Clear? So it's not a right anymore. It will not be exercised. Simple. Now, who are the parties to the options? Any questions? No. Perfect. So let's discuss about the parties to the option, students. So in case of a right to buy, okay, if we talk about right to buy, there is a holder, there is a writer, okay. Holder means the person who has purchased the right to buy. Right to buy was what? Call option, right? The right to buy means the person who has purchased the right to, sorry, the holder means the person who has purchased the right to buy. That person is called as the buyer. He is the buyer of the right. But please do not confuse it with the buyer of the underlying. Buyer of the underlying can be a different person altogether. That is happening in the spot market. This is a options market. Options market buyer of option will be different than the buyer of the underlying. Similarly, writer. The option writer means the seller. Okay, the seller of the right means the person who is selling the right, and that means that person is undertaking the risk. At the same time, please don't confuse this with the seller of the underlying. Now, on expiry, what will happen? On expiry, if this contract is getting settled on gross basis, then the buyer or the holder of the contract will become the buyer of the underlying, and the seller of the right to buy will become the seller of the underlying. Okay, this is on expiration. Now, if you talk about right to sell, students, this is a put option. For right to sell put option, again, there are two parts. One is the holder, second one is the writer. The holder or the buyer is the buyer of the right to sell. The writer or the seller is the seller of right to sell. Okay. On settlement or on expiry, the buyer of right to sell will become the seller of the underlying, students. Correct? And the seller of right to sell, if I'm selling the right to sell, tomorrow if that rights get executed, I will have to purchase the shares, right? So I will become buyer of the underlying on expiry in case the settlement is happening on a gross basis, students. Clear? Now, this actually explains the entire summary of the options. Now, Mr. A, who is a holder, can be called as the buyer, is holding the privilege, right? And the holder can be of two things, right? One is the right to buy or right to sell. Right to buy is call option, right to sell is put option. Now, Miss B is the writer. Writer means the seller of the right. Seller of the right to buy or seller of the right to sell. Just like insurance company. Now, Mr. A will pay premium to Miss B, and Miss B will sell these rights to Mr. A. Clear? So this premium represents that risk of adverse price movements is covered by Miss B. Simply, Miss B is covering the risk of adverse price movements, right? And they are also allowing that tomorrow, if you are already at a favorable position, you don't execute the contract. Okay. Now, this example, let's talk about this example, students, wherein we are saying that the strike price is 110, spot price is 100. Time is 3 months, and we are talking about European option, and the premium is 10 rupees. Okay, and X limited is the underlying equity share. So we talk about call option, which is a right to buy X limited equity share after 3 months at the rate of 110 per share. What will Mr. A do? Mr. A will pay a premium of 10 rupees to Miss B, which becomes the writer and seller. Now, from spot price perspective, if let's say on expiry, there are three different cases. 125. So at 125 to Mr. A, it will become favorable, right? Reason being, Mr. A is having the right to purchase at 110 for a equity share which is valued in the market at 125. So it is in the money for Mr. A. That means it is in the money. For 95, if let's say the price is 95 spot price, so I have a right to buy at 110, for which the outside market value is only 95. So is it a right to me anymore? No, it's not a right to me anymore, because I can go in the open market and purchase it at 95. So it will become out of the money, students, because it's not a right anymore. At 110, the holder is neutral, because it can go in the open market and purchase it at 110, or it can execute the contract. So it is actually immaterial. So it is at the money. So in the money, out of the money, or at the money, these are the three different stages. In the money will happen when the spot price is exceeding the exercise price. Spot price exceeding exercise price. If spot price is lower than exercise price, then it will become out of the money. If spot price is equal to exercise price, then it will become at the money. Clear? Okay. Perfect. So if we talk about the settlements part, students, right? If we talk about the gross settlement, then what will happen in all these three cases? If the price is 125, 95, and 110, right? These are the three different cases we took. So Mr. A will pay to Miss B 110 rupees in this case, because in this case the option will get exercised, but in these two cases nothing will be paid. Right? Because the option is not getting exercised. And Mr. A will receive one share here and nothing here. Correct? Now in case of a net settlement, Mr. A will receive the difference between these two, which is 15 rupees, in case the actual price is 125, and nothing in case the actual price is at 95 or 110. Now on inception, the Mr. A would have paid to Miss B 10 rupees as premium, right? So the net gain or loss will become 5 minus 10 and minus 10. Simple. 15 rupees positive minus 10 negative. So net 5 rupees, there is a net gain. And in other two cases, there will be a loss or equivalent to the premium that has been paid of 10 rupees. Okay. So from B's angle, net gain or loss will be what? In the first scenario, there will be a 5 rupees loss. There will be a 10 rupees gain. Correct? That's what the opposite of what is happening to Mr. A, that will happen to Miss B. So B will receive 10 rupees as premium in all the cases. In the first case, 15 rupees will be paid and balance 0 will be there. So this is minus 5, then 10 and 10 students. Okay. Then comes the underlying part wherein we say that the loss to the writer becomes gain to the holder. So if writer is losing, the holder will gain. If holder is gaining, the writer will lose. So the loss to writer is unlimited, correct? Because the writer is exposed to good amount of losses. It can also happen that the entire, if let's say the share price suddenly becomes 6,000 rupees, the loss to the writer will be very high in that case, in case of a call option. So we always say that there is a unlimited exposure to which the writer is exposed to. However, for holder, the gain is also unlimited. The gain is also unlimited because the share price, if it increases very high in case of a right to buy, the unlimited gain can come. However, the gain to writer is always limited to the extent of premium. And similarly, loss to the holder is also limited to the extent of premium, students. This cannot change. So now you understand the different perspectives of a writer and a holder. So the perspective of a writer is that you are exposed to the unlimited risk, hence you charge a premium. The holder is actually entitled for an unlimited gain, and hence you end up paying premium for that entitlement. Clear? Now let's take the example of put option, students. Strike price 110, spot price again at 100, time expiry 3 months, it's a European option, and X Limited's equity share is what we are talking about. Okay. Now, Mr. A is the holder, Miss B is the writer, students. On expiry, spot price, if let's say the 95 is the actual price, it comes. What was the right? Right was the right to sell. Right to sell at 110. The market price is 95. The X Mr. A, who is the holder, will exercise the right. Reason being, by selling in the option, Mr. A will realize 110. By selling in the market, only 95 will be realized. So it becomes in the money option because spot price is lower than exercise price. Right? So this right will get executed at 110, the sale will happen. If the spot price is 110, we call it as add the money, because if you exercise, if you don't exercise, it will not make a difference. Spot price is equal to actual exercise price. Now, if let's say the actual price becomes 125, which is the spot price, it becomes 125. Now, in such a case, do you think it's a right anymore? You can sell the asset at 110 for which the open market price is at 125. So why will you exercise this right? You can just go in the open market and sell it at 125. So it's not a right anymore, and hence it becomes out of the money, students. Okay. So the holder of call option is always better if the spot price goes up and beyond the strike price. That we saw, right? The holder of the call option is beneficial if the spot price goes up and beyond than the strike price. The put option holder is better off if the spot price goes down and below the strike price. If the spot price is coming down of the strike price, then the put option holder is kind of better. Options, there is now the distinction between options and futures is options there is an underlying asset, futures also there is an underlying asset, there is a time limit, yes there is a time limit, but futures are always mandatory. Even if the price movements are not in favor to you, you will have to execute the futures. But options, it's a right, it can only be executed if holder is in the gaining position. There is a concept of strike price, there is a concept of future price, and hence there is a premium involved, there is no premium involved because it's a mandatory thing. So let me pause here, students, and ask for any questions to be answered. I'm checking all the query handle as well as the chat or any other questions that you might have, students. Okay, so with this, we have actually come to the end of the session. Now, I would request CA Ashish sir to please help with the concluding remarks. Thank you, sir.
Thank you, Divas. I have covered the topic of securitization,
Yes,
complete topic, and you have started with the derivative. So I
derivatives. Yes.
think in the same topic will be continued in the next revisionary session. So student,
Right, sir.
meanwhile you learn whatever have been covered in the class. Okay, so that if any query you can also ask in the next session, or even you can also ask us over the telephone, or as well as you can email to us. Divasa, just yeah. So
Yes,
this
sir.
is our email ID number, email ID, and this is our telephone number. So you can contact us in case you have any query. Otherwise, Divas sir will take up all the queries in the next session as well. So Divas
Yes.
sir, thank you very much for sparing your precious time and enlightening the student on this topic. And we
Thank you,
also
sir.
thank the student for the patient listening. Thank you very much and have a nice day. Thank you, sir. Thank you, sir.
Thank you, sir. Thank you, sir. Thank you.
Thank you, sir.
Thank you.
Yes. Okay.